This video is in our series on bad tax ideas, and it's about buying a vehicle and writing the whole thing off when it's not really for business use. Disclaimer, this is not tax or legal advice. Everyone's situation is different, so talk to your own qualified professional before acting on anything you hear in this video. So the pitch, you may have heard something like this, is buy a G-Wagon. It's over 6,000 pounds, so you can write the whole thing off. This one's all over social media. It's usually with someone standing in front of a luxury SUV saying the IRS will pay for your car, something like that, right? The truth is there is a legitimate tax rule behind it. Section 179 and bonus depreciation can allow for large deductions for heavy vehicles used in business. But the key word there is used in business. If your vehicle isn't used primarily for business, the deduction falls apart pretty fast, and it can turn into what I call fraud with extra steps. So let's break this down. Under Section 179, a business can elect to immediately expense the cost of qualifying property, including vehicles, instead of depreciating it over several years. So for 2025, the maximum Section 179 deduction is $2.5 million, and the phase-out starts at $4 million in total qualifying purchases. Once you go over that amount, the deduction gradually reduces until it's completely phased out. But here's the catch. To qualify, the vehicle must be used more than 50% for business. The deduction is limited to the percentage of business use, and if that business use later drops below 50%, you have to recapture part of the depreciation and pay it back as income. So if you claim 90% business use and later it's really 40%, that deduction doesn't just disappear, it becomes taxable income again. So you've probably heard about the 6,000 pound rule. And the reason you hear about G-Wagons and Escalades is that Section 179 treats heavy SUVs, those with a gross vehicle weight over 6,000 pounds but less than 14,000 pounds, differently from regular passenger cars. They're not subject to the same what's called luxury auto caps that limit how much you can deduct from most vehicles. So for 2025, the maximum Section 179 deduction for qualifying SUVs is $31,300. Bonus depreciation under Section 168K can also apply, allowing up to 100% of the remaining costs to be deducted if the vehicle is used primarily for business. But again, that's still subject to the business use percentage rule. So if your business use is 75%, you can only deduct 75% of the cost, no matter how you're deducting it. And with all of this, your documentation matters a lot. The IRS classifies vehicles as listed property under Code Section 280F, which means you must keep contemporaneous mileage logs showing the date, destination, and purpose of each trip and the business and personal miles driven. You also need receipts for fuel, insurance, maintenance, and registration. If you don't have that documentation, the IRS can disallow the deduction completely and require you to use the straight line method instead of the accelerated depreciation methods. Personal use also changes everything. If you're driving to client meetings or job sites, business use. Driving to and from your office, that's actually your commute, and it's considered personal even if you're thinking about business on the way. There is one potential exception. If you have a qualified home office that serves as your principal place of business, then driving from home to another work location is actually traveling from one office to another, and that counts as business use. Only the business use percentage is deductible. If you use the vehicle half the time for personal reasons, then half of the cost and related expenses is non-deductible. If the vehicle doesn't meet the weight test, meaning it's under 6,000 pounds, it's subject to luxury auto caps, which limit how much you can deduct each year. So even if you qualify, if you sell the vehicle or your business use drops below 50%, the IRS can trigger depreciation recapture, meaning part of what you deducted comes back as taxable income. That instant write-off can turn into a surprise tax bill later. A few things to remember. The vehicle must be owned by the business or used in the active conduct of the trade. Commuting is personal unless you qualify for the home office exception. You must report deductions on Form 4562 and carry the business use percentage to your business return. So some common pitfalls I see. Claiming 100% business use when that's not realistic. Failing to track mileage property. Trying to write off a personal vehicle that isn't actually owned by the business. Assuming the over 6,000 pounds means no rules, so it doesn't. Still a lot of other rules apply. Forgetting that recapture can undo the tax benefit when you sell it or you reduce your business usage in a future year. The bigger point here, if your tax strategy involves buying a luxury SUV you can't afford just to save on taxes, you don't have a tax strategy, you have a spending problem. And if the only way your business can make money is by playing games with fake write-offs, the problem isn't your CPA, it's your business model. Don't chase shiny loopholes that create IRS risk and cash flow strain. Build a company that's profitable and sustainable and use real defensible tax planning to support it.